Welcome to The Explainer. Today, we're going to pull back the curtain on something that shapes our world every single day, whether we realize it or not: the financial market. So think about it. You work hard, you put some money away in the bank. On the other side of the country, some company has this brilliant, game-changing idea, but they need money to get it off the ground. How does your cash get from your account all the way over to their project? Well, it turns out there's this massive, invisible bridge that makes it all happen. And that bridge, that's what we call the financial market. Now, finance has some fancy terms for this. On one side, you have surplus units. That's really just us, the savers with a little extra cash. And on the other side, you've got deficit units. Those are the businesses that need that cash to expand. The financial market is the crucial link that connects the two. And this whole money bridge setup is designed to be a win-win. It takes your savings and puts them to work, helping build new factories, create jobs, you name it. And in return, you get the chance to earn more on your money, something it could never do just sitting under your mattress, right? So let's break down how this flow of money actually works.
It's really a pretty simple three-step journey. First, it all starts with savers. People like you and me, we deposit our money in banks, maybe buy some stocks. Step 2, the financial market itself, think banks, stock exchanges, all that stuff, gathers up all these little pools of money. And finally, step 3, it channels that massive collection of funds over to the borrowers, the businesses that are ready to use it to create something new.
Okay, so the money is flowing across this bridge, but it doesn't all travel down the same highway. See, a business might just need a quick loan for a few months to cover payroll, or it might need a huge long-term investment for a project that'll take a decade to build. To handle these different needs, the market splits into two main paths. And those two paths are the money market and the capital market. The money market is for all the short-term stuff, anything that's for a year or less. It's generally lower risk. But the capital market, that's for the long haul. We're talking about the big projects that last for more than a year. This is where you'll find things like stocks and bonds, which, yeah, they come with higher risk, but also the potential for much higher returns. All right, let's zoom in on the capital market for a second. The one for those big, long-term investments. Even inside this market, there's another really important difference. It's kind of like buying a brand new car straight from the factory versus buying a used one from somebody else. So this brings us to two distinct places to buy. First up is the primary market. This is where a company sells its shares for the very first time. You might have heard of it as an IPO, or initial public offering. You're literally buying directly from the source. But then you have the secondary market, which is what we all think of as the stock market. This is where investors buy and sell those already existing shares with each other. But you know that secondary market, the stock exchange, it's so much more than just a place to trade. It actually performs some absolutely vital jobs that have a huge impact on the entire economy. For starters, it acts like a giant economic barometer. You can think of it as taking the pulse of the economy. If you see the major stock indexes going up, it's usually a pretty good sign that businesses are confident, growing, and the country's economy is in good shape. If they're heading down, well, it could be a warning sign of trouble ahead. Second, it's this amazing price discovery machine. The price of any given stock is constantly being set by the simple, powerful forces of supply and demand. How many people want to buy it versus how many people want to sell it. It's this constant tug of war that helps figure out what a company's shares are actually worth at any given moment. And third, and this one's super important for all of us, it provides safety. The whole exchange is a structured, regulated environment. Only companies that meet some really strict criteria can get listed and have their shares traded there. This adds a huge layer of transparency and protection for every investor. Okay, so that brings up a pretty big question. We've got all these rules and regulations, but who's the referee? Who's making sure everyone is playing fair and protecting regular investors from getting scammed? Well, most countries have a special regulatory agency that acts as the market's watchdog. Here in the United States, that's the SEC. In India, for example, that job belongs to SEBI, the Securities and Exchange Board of India. And the main job for these agencies boils down to a few key things. First and foremost, to protect investors like you and me. Second, to stop fraud and shady practices like insider trading. And third, to regulate all the players in the market, from brokers to big firms, to make sure everyone is following a clear set of rules. So, at the end of the day, why does any of this matter? Because when you step back and look at the big picture, the financial market is a powerful engine for progress. It takes the small savings from millions of different people,
bundles it all together and channels it into the biggest, most ambitious projects, funding the companies that invent new technologies, build our cities, and create jobs.
So when you participate in this system, you're not just investing to build your own future. In a way, you're casting a vote for the kind of world you want to see built. So the real question is, what amazing idea will your savings help bring to life?